We've seen major swings in Tesla's stock price, often leaving investors wondering what's going on. But after the latest financial report, a more consistent pattern is emerging, giving us a valuable chance to understand Tesla's investment potential. In today's analysis, we'll break down the Q2 financials, identify the key drivers behind Tesla's stock price, and look at what could happen in the months ahead. Let's start with the numbers. Tesla reported $22.51 billion in revenue this quarter, which met market expectations but marked a 12% decline year over year. Net profit came in at $13.91 billion, slightly below the expected $14.61 billion, and down from previous highs. While there's been a slight rebound in both revenue and profit, overall growth has been stagnant for more than 2 years, with profits still hovering near a low point. Tesla's automotive revenue totaled $16.7 billion, a 16% drop year over year. This was expected based on prior delivery reports. But the surprise came in the gross margin. Automotive gross margin hit 17.2%, beating expectations of 16.5%. And excluding carbon credits, the margin rose to 15%, significantly higher than the 13.3% analysts anticipated. This uptick is likely due to higher vehicle prices, with the average revenue per car now reaching $43,400. Tesla's energy business also took a hit, though its effect on the overall stock price remains limited. Revenue for this segment was $2.79 billion with a 33% gross margin, reflecting a 5.7% increase year over year. Despite the impact of tariffs, demand remains strong, and Tesla plans to continue investing in the U.S. to offset future tariff risks. So what does all this mean for investors? The key takeaway is that automotive gross margin, not profit or revenue alone, remains the most critical metric. And that number has rebounded better than expected thanks to rising vehicle prices and improved production efficiency across all factories. The decline in overall profit is mostly due to lower carbon credit revenue, which isn't a core part of Tesla's valuation model. R&D spending is also up, putting pressure on margins, but the long-term impact is limited. So, this financial report isn't as negative as some may think. In fact, it leans positive. But here's where things get interesting. Even with this fairly positive report, Tesla's stock price fell. Last quarter, after a much weaker report, Tesla's stock actually jumped 20% in just 3 days. What's going on? The answer lies beyond the balance sheet. In the last quarterly meeting, Elon Musk painted an optimistic picture, laying out timelines and bold plans that energized investors. That vision, not the actual financials, drove the stock higher. The market clearly responds more to forward-looking technological developments than raw earnings data. Fast forward to this quarter. Even though the fundamentals improved, investor excitement didn't follow. Why? Because the latest report lacked the same kind of bold, near-term technology promises. Looking ahead to Q3, there's some cautious optimism. The expiration of the $7,500 federal EV tax credit on September 30th may trigger a short-term spike in sales as consumers rush to qualify. That could give a temporary boost to earnings. In China and Europe, Tesla's market outlook also appears to be improving. A newly launched model in China is already seeing strong demand, and a long-wheelbase version may draw in new buyers. In Europe, the early life cycle of another new model presents further upside. Concerns about tariffs appear manageable for now. Most of Tesla's U.S. sales are domestic, with over 85% of components sourced locally. And Tesla has already made adjustments to its international supply chains to reduce tariff exposure. While carbon credit revenue in the energy segment may face pressure, their effect on stock price remains limited. So what's the outlook for Q3? Fundamentals look relatively stable. But the spotlight is now on technology trends, especially Tesla's Robo-taxi ambitions. Musk's tone this quarter was more cautious, suggesting that scaling the Robo-taxi platform faces major hurdles, including cost, safety, and regulatory approval. This muted tone may limit investor excitement in Q3. Technological momentum might stall, even as fundamentals hold steady. That could lead to a relatively flat stock price with limited downside risk, a potentially stable window for investors. But the fourth quarter presents more risk and more opportunity. The two big concerns. One, the end of the $7,500 tax credit could lead to a drop-off in sales. 2. Increased capital spending and R&D costs may put more pressure on cash flow. However, there are potential positives too. The new long wheelbase model in China could drive growth, and Tesla's efforts to develop a more affordable vehicle are moving forward. In terms of tech milestones, Q4 could be pivotal. Whether it's robo-taxi development or major software updates, these will heavily influence the stock. Investor expectations are high, and any major update or setback could trigger strong market reactions. In short, Q4 is shaping up to be a make-or-break period for Tesla's stock. From a long-term perspective, Tesla's value still hinges on its ability to deliver breakthrough technology. That long-term vision is intact, but short-term volatility is something investors should be ready for. That wraps up our Q2 breakdown of Tesla's financials and market outlook. We'll continue tracking major updates in Tesla's business and technology to keep you informed every step of the way. Thanks for watching Stock Daily, and we'll see you in the next video.